a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know this morning. Risk on rate cut bets. Global stocks hit a record high after inflation data lift expectations of Fed easing. Could that be a jumbo cut? Treasury Secretary Bresson says the Fed should be open to a half-point cut next month. And President Zelenskiy and European leaders gear up for a call with President Trump ahead of the U.S.-Russia summit. So it was the 16th record high for this S&P 500 yesterday. We're up more than 1%, and we add some weight to it this morning, just about 0.1% for S&P. NASDAQ, that also hit a record too, up about 0.25% this morning, all after the inflation data. Even though some of the services look sticky, even though core was running a little bit hotter. But never mind, this is a market that was gearing up for a much worse number. So in that, you got a rally on the front end of the curve yesterday. That continues this morning. We're down by 2 basis points. We're pricing at about 97% odds that we'll get a cut. The long end, though, that interestingly was under pressure yesterday. Turns to a rally this morning, both the 10 and 30-year yield down by about 3 basis points at 425.58 for your 10-year yield. Let's look at some of the stocks moving in the pre-market this morning. With that is Valerie Teitel. Hey, Val.
Good morning, Danny. Let's start with CoreWeave. Out with results, and investors are very concerned about their run-up in costs. Their costs have increased 20-fold over the quarter as they race to build out this AI data center capacity. The stock is down 9% in pre-market trade. Note, though, Danny, the stock has quadrupled since its IPO back in March, so maybe a bit understanding that it gives some of those gains back on these disappointing results. Let's move on to fast food. The fast casual chain Cava cutting its sales guidance on the back of a softer diner. Now, this kind of chimes with what we've heard from Sweetgreen and Chipotle, that the U.S. diner is pulling back on restaurant spending, whether they're fretting about tariffs or increased inflation is really remains to be seen. But Cava losing 24% of its price in pre-market trade. Lastly, let's go to the digital asset sphere. Circle is falling in pre-market. This is the company that backs the stablecoin USDC, the second biggest stablecoin out there. The shares are falling over 5%. Danny, this is due to an announcement of a share offering. They're going to be announcing or offering $10 million worth of shares later today, and the CEO is involved in that share sale. Danny.
Valerie, thank you very much for that roundup. We'll catch up with you later in the hour. Also this hour, in just moments, Tim Graf of State Street will join us, where he sees cracks in the U.S. economy. And we'll discuss this record rally in stocks with JPMorgan, Sitara, Sundar later in the hour. Markets, though, are betting on a near certainty that the Fed will be cutting in September after yesterday's data. Tim Graf of State Street writes, easing this year keeps rates in restrictive territory, and sustained high or higher U.S. rates could derail risky assets, echoing the 2022 correction. Tim Graf is head of EMEA macro strategy at State Street Global Markets and joins us now. Tim, so a market pricing in cuts, but is it your assumption, just given that we will get cuts and still remain in restrictive territory, that we won't go neutral or accommodative?
Yeah, I think it's not just my assumption, it's the Fed's assumption, right? There's not a single kind of long-term or a short-term dot, I should say, that's not above the long-term dot. So, one cut, 2 cuts still has Fed policy by the Fed's own definition and by every member's definition of it in restrictive territory, which is why I think we will start to see that accommodation come through starting in September, probably at least one more cut this year, if not a third cut by the end of the year, but certainly in line with the 2 cuts that the Fed projections have for the end of this year.
It's the assumption by the Fed, Tim, but is it the assumption by risk markets? With stocks at an all-time high, are they pricing in something different?
I don't think so. I think they're pricing in the continuation, in my view at least, of the soft landing of the U.S. economy, which, to be fair, you probably do need further easing to ensure. We are not yet in the camp of looking for a recession, certainly not a deep recession. But I think to avoid those outcomes, to avoid kind of the scenarios you alluded to in that quote I had, you do need to start to think about resuming the path of easing and getting policy rates back towards not even easy territory, but just to neutral territory to ensure the stability and health of that soft landing.
One of the crazy things, Tim, is that tariffs don't seem to be anywhere as the driver, either where our assumptions are about the economy right now or where the market is going. We thought that it would be the main driver. We thought it would drive everything at this point, Tim. Does it reinforce itself at some point, or does it just remain a sideshow for now?
I think the really key thing here is we adjusted our expectations quite dramatically already, whether it's looking at market pricing for inflation in inflation swaps, that they priced in the effect of tariffs quite quickly around the time they were introduced. The Fed themselves at the June meeting, and I think this is what's really important about policy, the Fed really raised their inflation forecast at the June meeting to a level that they might actually overshoot now on that forecast. It's going to take really strong readings from core PCE for the remainder of this year for that inflation forecast to be realized. And this is, there's still residual seasonality, I think, in a lot of the inflation data. This is the period where seasonally inflation tends to be a little bit weaker. So it's not that tariffs aren't having an effect. It's that that effect was, I think, calibrated for a long time ago. And the fact that you're getting data like yesterday, which doesn't look great, but also is not as worrying as what those elevated expectations were, I think that's why you're seeing the reaction in risk markets. It's not to say it's great, but it's not nearly as bad as how markets and the Fed themselves adjusted for that expectation.
Tim, there's also a lot of politics happening, not behind the scenes. At this point, it's very much so happening in front of us. A new appointment, we'll see if he gets confirmed. The head of BLS was speaking on Fox Business yesterday, saying that maybe we should suspend jobs data. The Wall Street Journal also has a story out saying that Trump has been complaining that the jobs report is designed to hurt him. And he is specifically taking aim at those large revisions, saying that he doesn't want large revisions in the data in the future. Tim, again, not something that's bubbling up to the market surface. And there's the quote from E.J. Antoni there saying about through less timely quarterly data. But Tim, does this concern you if there are adjustments to how and when and how the data is collected and just in general, those monthly job reports?
Look, I think for 20 years, you could make the claim that revisions to payrolls will always kind of throw you off balance, right? You get the initial read, and then for the next 2 months, you have to figure out whether that was right or wrong. But nevertheless, that initial read is what markets trade off of. And I think it's a fair critique to say that the size of the revisions, especially over the last couple of years, given declining response rates, especially to BLS surveys, it's an issue. And data quality, we should always strive to improve data quality. But there is a concern, I think. There's enough institutional inertia at these places that I think the wildest fears are maybe a little bit overblown. But the probability that institutional credibility is weakened, I think, is probably higher than it was a month ago. And so it is something we should be concerned about, but I don't necessarily think it's something we should be panicked about, because as long as the work that's being done to improve data quality is apolitical, which, again, we can maybe argue whether that will be the case or not, but there's a good chance it will be apolitical. If there's data quality improvements, that is to the good. We do need to account for some of these institutional concerns, though, for sure.
Tim, is the long end accounting for them? Because after CPI yesterday, throughout the day, you saw the long end drift higher. How much of that was about the inflation data itself and some of the makeups of it versus some of the institutional credibility concerns that you're talking about?
Yeah, it's a really good point. A little bit of both, I think, but I think the long end seems to be responding more to these headlines about who's going to get appointed to the Fed, who might be the candidates for Fed chair. That especially, in recent weeks has been, I think, the focal point for the long end. If it's more of, say, a MAGA candidate, you get the long end selling off. If it's, the converse, where you have someone like Waller who's mooted last week as the favorite, then it rallies back. I think that is the key right now for the long end. It's not to say the inflation data is unimportant. It clearly is. But when it comes to bringing in that long-term risk premia in U.S. rates, the institutional credibility argument, I think, is best expressed that way.
Well, Tim, if we can just bring this whole conversation right back around, if there is a vulnerability in risk assets in stocks to get something that looks like 2022, what is the ballast? Given what you're saying about some of the concerns in duration, where do you seek shelter? Yeah, it's a good question. I mean, for right now, cash still offers you decent yield until the Fed does ease. And so if you really are concerned about that very, very short term, that's probably a good place to hide. Now, overall, we actually still really see quite risk-seeking flows. And I don't suspect there's going to be anything that really knocks us off target on that for the next few weeks. And so maintaining allocations to equities probably is fine for right now, particularly, the usual names that you probably spend a lot of your day talking about. Those tech names that have strong balance sheets, strong earnings potential, and great future earnings prospects
are probably, they're not safe havens, but they're probably not bad places to hide out.
Just quickly, you said for now. When does it become not for now?
Yeah, sure. Fair question. I think early Q4 is when you'll probably start to see data in either direction. I think there's two tail scenarios here, right? Where inflation could take off because of tariffs. I'm not a huge believer that that's going to happen. But more, I think, worryingly, the slowdown in the labor market. By then, you will have a better sense of whether this is kind of a false flag, like last year's rise in the unemployment rate was, or if we are really seeing the labor market cracking. That's where I think risky assets have a problem.
Fair enough. So the catalysts come in September. We can go to the beach for now. So that's good news for this August. Tim, thank you so much for joining. Tim Graf of State Street. Let's get you some other top stories that are trending on the terminal this morning. Global oil markets are on track for a record surplus next year as demand growth slows and supplies swell. The latest IEA report says inventories will accumulate at a rate that surpasses the average buildup during the pandemic in 2020. Elsewhere, India and China are restoring economic ties strained by a clash at the border in 2020. Prime Minister Narendra Modi will be meeting Chinese Premier Xi Jinping for the first time in 7 years, a sign that India is drawing closer to other BRICS countries following President Trump's new tariffs. And the latest twist in the Musk versus OpenAI court fight. A U.S. district court ruled that Elon Musk must face claims by OpenAI that his attacks on the startup amount to years-long harassment campaigns. A trial in Oakland federal court is scheduled for March. Coming up on the show, Besson suggests a jumbo cut in September. More on that, and don't miss an interview with Scott Besson coming up later on U.S. programming. You're watching Bloomberg TV.
I think the real thing now to think about is, should we get a 50 basis point rate cut in September to make up for the delay and the lack of data?
Treasury Secretary Scott Besson speaking after yesterday's benign inflation report. He was speaking on Fox Business in a wide-ranging interview. Let's unpack some of it with Bloomberg's Jill Desis. Jill, great to see you this morning. It's interesting to see it's not just President Trump upping the pressure for jumbo rate cuts. It's Scott Besson as well.
Yes, that's right, Danny. And I think, obviously, while you have markets pricing in a rate cut for the next meeting, certainly I think this jumbo size cut 50 basis points, a bit out of expectation there. So it does feel like that pressure is ratcheting up a bit. I thought what was really curious about Scott Besson's comments there is that he's really kind of doubling down on what has been this broader criticism that the Trump administration has had towards some recent data. So his comments he was making right after that inflation report, as you mentioned, but he also cited, when he was making the case for a 50 basis point cut, the revised jobs figures. So pointing specifically to those May and June figures is saying, look, if we had that data earlier, if we had those revised figures earlier, then we should have started cutting rates earlier. So I think that, kind of tying all that in together, and that package of how exactly the Trump administration is, one, piling pressure on the Fed to cut rates, but also two, pointing to some of its issues with some of the recent economics data, I think kind of paints a fuller picture there.
It wasn't just the data that Besson talked about. He also dismissed that China may invest in the U.S. as part of a trade deal. Jill, let's take a listen to that.
I think your initial question, Larry, was, could China do a buyout like this?
Yep.
And my sense is no, because a lot of the buyout or the funds from the buyout are going to go to critical industries that we need to reshore, and a lot of those need to be reshored away from China.
Jill, it's different than the approach to other countries, which is invest in the U.S. and maybe you get a better deal. What is the differing approach with China as we get that 90-day extension?
Yes, that's right, Danny. Well, I don't think that these comments are really all that surprising at all. I mean, I think it makes much more sense for the U.S. We clearly have seen the playbook with the European Union, with Japan, with South Korea, with countries that do have much closer sort of diplomatic ties as allies, certainly to the United States, saying, open a multi-$100 billion investment fund and then invest in the United States, and maybe you get a more favorable deal. China, though, obviously a major economic partner with the United United States, but also a strategic adversary. And of course, the United States has longstanding concerns, national security concerns around China, has talked at length, both in this administration and the Biden administration, prior administrations, about ring-fencing certain industries, that concern about China's development of advanced technologies and such, and how exactly that sets up China, as sort of that competitor with the United States on a global scale. So I think it does make sense that an investment pathway for China is not available, in Trump's eyes or in Biden's eyes, as maybe it is with other nations. What I do think that leaves open the question of is, we've got this pause in place for the U.S. and China to continue hashing out, rules over how exactly their trade relationship is going to look. But ultimately, what kind of concessions do you make? I mean, China continues to, have in its back pocket that idea of its control over rare earth supply. Obviously, that's been at issue throughout negotiations this summer. But then, where exactly do you go from there? I think that it's a really, really open question here. Maybe you expand this out another 3 months or so, but I'm not sure how much that actually gets wrapped up by the time this truce once again hits a deadline in November.
Jill, it was also just a busy day for officials on Fox yesterday because the new appointee, we'll see if he gets confirmed to the BLS, E.J. Antoni, was on Fox 2. And Jill, this is what he said. Until it is corrected, the BLS should suspend issuing the monthly jobs report and keep publishing the more accurate, though less timely, quarterly data. Jill, there was also reporting from the Wall Street Journal that Trump has been taking aim at the revisions specifically because he thinks they hurt him politically. What could all of this look like? And is this possible to do?
Well, Danny, I would point out that in other major economies around the world, sometimes you do see cases of, governments not publishing data and then coming out with it later. A really prominent example to me is China, the world's second largest economy, which just a couple of years ago actually stopped publishing some data on youth unemployment and then brought it back several months later. There's several other economic indicators, that they held off from as well. Look, I think, at this point, obviously the Trump administration has taken quite a lot of issue with the severity, the magnitude of those revisions. We also know that Trump often likes to criticize, numbers that he doesn't necessarily like. We'll see what happens with this BLS nominee, but ultimately, yeah, I think lots to unpack there.
So much to unpack. Jill, thanks for doing it for us. Jill Desis. And tune in 7:30 a.m. Treasury Secretary Scott Bessent will be on Bloomberg Surveillance. Stay with us. Watching Bloomberg Brief, I'm Danny Berger in New York. Let's take a look at the front pages this morning. What's making headlines on the major publications? First up, a Wall Street Journal exclusive that AI startup Perplexity has offered to purchase Google's Chrome browser for $34.5 billion. Sources there saying that several investors, including large VC funds, had agreed to back the transaction in full. Next up on the Washington Post, President Donald Trump deploying the National Guard in D.C. on Tuesday night to what he says to curb crime. It does remain unclear what new directives the D.C. police would receive from their new federal managers. District officials said that they were still in command of the department. The White House, however, continued to project clear control. And on the New York Times, German Chancellor Friedrich Merz and Ukrainian President Volodymyr Zelenskiy, along with several allies, will be hosting President Trump for a video call later today. All of that comes ahead of a Trump-Putin summit in Alaska on Friday. Let's talk more about that summit and that phone call. Joining us with the latest is Bloomberg's Greg Sullivan. Greg, what are we expecting from this phone call today?
Well, there's a few things. One, it's obvious that President Volodymyr Zelensky and the European leaders will not be at the table at the summit on Friday. That will be a summit only between President Trump and President Vladimir Putin. For European leaders and for Kiev, that there's a potential nightmare scenario where there's a deal that is agreed to that they ultimately can't accept, that just crosses their red lines. So they are trying to telegraph to President Trump what those red lines are, what ahead of time, and try to press their own concerns about security guarantees, potential red lines, and also trying to convince Trump to ratchet up the pressure on Vladimir Putin rather than accept a bad deal. So this is a very important phone call for them. Their only chance to try to leverage influence with President Trump ahead of his meeting with Putin.
Greg, only a minute here, but what are the expectations for Friday? How has the administration been speaking about this?
Well, from the White House and the administration in general, we've heard them tamp down expectations. President Trump himself said that he's willing to walk away if there's no deal to be had, called it a feel-out meeting where he's going to assess the possibilities for a deal. But we also know that if the White House is willing to put Trump and Putin in a room together, they probably want something tangible to walk away with, whether that's a framework agreement or a deal to keep talking or just a step in the next direction. They want something to show. Whether that happens or not, we'll have to wait and see on Friday. But for now, they are tamping down expectations.
Greg, thank you very much for that update. That is Bloomberg's Greg Sullivan. Oil markets, they are weaker this morning, not necessarily in anticipation of that, but after the IEA casted a gloomy outlook for the months ahead of surpluses that would rival that of COVID. Okay, coming up, global stocks are at a record high. We're going to catch up with JPMorgan, Sitara, Sundar. That's coming up next on your Bloomberg Brief. Stay with us. It's 5:30 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know on this Wednesday. Risk on rate cut bets. Global stocks hit a record high after inflation data lifts expectations of Fed easing. Could that be a jumbo cut? Treasury Secretary Bessent says the Fed should be open to a half-point cut next month. And President Zelenskiy and European leaders gear up for a call with President Trump ahead of the U.S.-Russia summit. The 16th record high for this S&P 500. We were up more than 1% yesterday. We add to that this morning after a CPI-fueled expectations, 97% odds that we'd get a rate cut, up by 1/10 and 2/10 for the S&P and NASDAQ. For this bond market, it is a rally this morning. It was a rally yesterday, but really only on the front end, but it goes across the curve this morning. We are lower by 3.5 basis points for your 10-year yields at 425.39. Let's look at some of the stocks on the move this morning. With that is Valerie Teitel. Morning, Val.
Good morning, Danny. Let's start with CoreWeave. There was a pretty disappointing result out after the bell yesterday, talking about costs surging 20-fold. This has really shaken investor confidence in their margins. We're seeing that stock trade down 9.2%. This could all be about this really big race to spend to build those data centers, and we're seeing those margins struggle off the back of it. Now, note, CoreWeave has quadrupled since its IPO since March, so it puts that 9% drop just a bit in perspective. Let's move on to the dining sector. Some bad news when it comes to guidance on how diners are spending. We've seen the fast casual restaurant chain Cava drop 23% in the pre-market, warning of softer sales ahead, warning of this soft consumer. This is a very similar picture that we've had painted by the likes of Sweetgreen and Chipotle, all warning that consumers are still focused on inflation and pulling back on restaurant spending. Next, let's head over to the digital asset space. We're seeing the likes of Circle fall in pre-market trade. Now, this is off the back of a round of share sales happening tomorrow. The CEO is involved in this share sale, so it's jittering the stock at the moment, down nearly 5%. Remember that Circle is one of the stablecoin issuers. They back USDC, the second largest stablecoin on the market. Danny.
Val, thank you very much for that update. That is Bloomberg's Valerie Teitel. Now, with stocks at an all-time record, JPMorgan Sitara Sundar writing, quote, "We see near-term pain and long-term macro gain in our macro outlook. We expect investors to look through near-term weakness and focus on a 2026 recovery." I'm pleased to say Sitara joins us now. She's head of alternative investment strategy at JPMorgan Private Bank. Sitara, wonderful to see you this morning.
Lovely
Thanks for joining.
See you too.
So how much of that is in the price of these expectations for 2026 if risk assets are already at all-time highs?
So it's a question that we've been asking ourselves, honestly, pretty consistently since we've seen a pretty monstrous rally since the lows in April. But the bottom line for us is we still see mid-single-digit upside through next year. We actually just upgraded our S&P 500 price target to 6,650 to 6,750, which means about 5% upside from here. And when we think about global markets, we actually upgraded some of our forecasts there and actually narrowed some of our ranges, given that we're seeing a little bit more clarity on the policy side and on the economic front side. But then the underlying question is like, where is that constructive outlook coming from, and where is that bullishness coming from?
I was going to go. So where is it coming
Read
from?
your mind. So there's a couple of pillars of it. One, the biggest thing for us is that we're expecting that upside to come from earnings growth. We're not waiting for a gift from the Fed. We do expect the Fed to cut about 100 basis points over the next year, but some of that is already priced in. So we're expecting earnings growth to be led not just by tech and comm services, of which we've seen pretty healthy growth even in this past earnings season, but financials and other parts of the market too, utilities too. So we're starting to see a little bit of that breadth, and we expect to see that breadth continue over the next year, one. Two, we're actually starting to see really positive green shoots on global IPO and M&A activity as well. I think people forget about the capital market activity story when they're talking about public markets, and we're starting to see green shoots. And honestly, if you look at May and June, it's actually the strongest IPO and M&A activity months that we've seen globally since May of 2022. So positive signals there. And then finally, I would dispel the notion that equity markets are complacent right now, because that's the other pushback that we've gotten. And what we're actually seeing is pretty firm delineation from an earnings perspective and even from a return perspective on the areas that are what we would think are a little bit more immune to tariff risks, some of the more secular areas of the market, tech, really software versus semis, but remains to be seen on what the underlying impact of tariffs are going to be to semiconductors, versus the discretionary side and the more consumer-oriented sides where there's a little bit more uncertainty as to what the impact of tariffs are going to be, and the smaller cap areas. We're leaning into large cap. We're still avoiding small cap in public markets at that time. We would prefer to take that exposure in private markets.
There have been a couple people that have looked at this earnings season, and I would say JPMorgan and Neil Dutta are among them, who have said that companies for now are absorbing any sort of price hikes in their margins. I think the Goldman stat was about 2/3 of companies are. And at some point that ends. If that does end, do you assume it comes in the form of just higher prices, a little bit of stickier inflation, or is it weaker growth as consumers push back and maybe there's less spending by companies and cost cuts and layoffs?
Yeah, so I think two things. One, we still think that there's time and the margins are healthy enough and more robust than they were even in the 2018 period when we experienced this kind of trade war dynamic, and even prior to that. So we still think there's a healthy enough margin that the time for those decisions to be made with at least certain companies, and especially those secular growers, there's more time to be able to make that decision. Two, right now, you're right, we haven't seen as much of a pass through to the consumer as we've seen in prior trade wars. But if you were to ask me, which you have, we likely are going to see the pass-through come through higher prices and therefore a little bit stickier inflation, which is the number one question that we've been asking ourselves too. We believe that we're in the midst of a regime shift where we're going to see moderating economic growth. Rates are going to come down but stay more elevated than the prior cycle, and inflation is likely, at least in the near term, going to inflect a little bit higher given the impact of tariffs. Still not at a level where we're concerned about stagflation and like 1970s type of stagflation risk. But in that type of environment, we've been really talking to clients about ensuring that the building blocks of their portfolio evolve in lockstep. Because the seasons are changing, right? You change your wardrobe. If the season is going to change, if the regime is going to shift too, the building blocks of your portfolio should change as well.
Well, to that point, because the space that you cover, alternatives, it's often said is, a really good way to diversify when things are volatile, but things aren't really volatile right now. Stocks are kind of melting up. Bonds have been trading in a tight range. Are we going to get to a place again, is this what you're saying, that volatility might rear itself and you need that diversification?
Yeah, I think there's like two things. One, the inflation, it's like market volatility versus economic volatility. Market volatility, it's definitely subsided, but when you look at the VIX and the MOVE index, still at elevated levels versus history. So that volatility is there, but the inflation volatility, we don't actually expect to go anywhere anytime soon. We still expect to see that. So there are pockets of alternatives that actually can provide you inflation resilient income within your portfolio, because we're still seeing volatility on the long end of the curve within within the core fixed income space. So those longer duration bonds are likely not going to be able to protect you as well in an inflation shock versus an economic shock. So what does that inflation resilient income look like within alternatives? Infrastructure is a key area, not just in providing that income, given the focus on resilience of that income because of multi-year contracts that are backing those cash flows, but also the secular tailwinds that we're seeing within that space, acceleration of power demand and the acceleration of capex that we expect to see within the infrastructure ecosystem, not just within the U.S., but globally as well.
All right, Sitara, we're going to have to leave it there. Thank you so much for joining this morning.
Thank you for having
really
me.
Appreciate it. That is Sitara Sundar of JPMorgan. Let's now get you some other top stories that are trending on the terminal this morning. Global oil markets are on track for a record surplus next year as demand growth slows and supplies swell. The latest IEA report says inventories will accumulate at a rate that surpasses the average buildup during the pandemic in 2020. Tencent topping quarterly revenue estimates and turning its attention to the AI race. China's most valuable company boosting its spending on AI in an effort to integrate the technology into more services and content. And Texas Democrats are considering their options amid reports that they could return to the state as soon as this weekend. The move would end a standoff where more than 50 state representatives left in a bid to block controversial new congressional maps backed by President Trump. Coming up, CoreWeave comes up short, shares down by 9.33% this morning after a disappointing outlook. That conversation coming up next. Stay with us on your brief.
The tariffs and trading wrapped up by the end of October?
That's aspirational. The big trade deals that aren't done aren't agreed. You know, Switzerland's still around. India's been a bit recalcitrant. I think we will have agreed on substantial terms with all the substantial countries.
Treasury Secretary Scott Bessent doubling down on his statement to the Nikkei, saying that substantial trade deals should be largely wrapped up by October. Let's get the latest with Bloomberg's Brendan Murray, who covers trade for us. Brendan, what do these comments suggest as to where China and U.S. talks are?
Well, the comments from Bessent on China suggest that there's a fairly narrow path for the U.S. And Beijing to reach some sort of trade deal. If he's basically taking Chinese investments in the U.S. off the table, then that leaves, it leaves the two sides with a lot to sort out. Remember, we heard President Trump ask China to buy more soybeans, purchase American exports, and we didn't hear anything from China in the aftermath of that. In fact, Xi Jinping had a call with the president of Brazil, which is a big soybean exporter. So what we're seeing is with the extension, the 90-day extension that President Trump signed off on for this China tariff truce, where it's getting more and more difficult to see how they're going to come together and agree on anything that you could call a trade agreement.
Brendan, there continues also to be this rupture between the U.S. and India, and we are seeing some normalization of ties, it would seem, between India and China. How is this dynamic evolving?
Yeah, exactly. So as the U.S. becomes more of an antagonist in the global trading system, these countries that depend on trade are trying to realign themselves with each other. China and India had a falling out over some security and border issues, and they look like they're trying to patch some of that up now. And of course, we've had the BRICS countries in recent days show more and more signs of unity. So as the U.S. Kind of draws this tariff wall around itself, other countries are not retaliating for the most part, and they're trying to, as they would say, diversify their trading relationships with other countries and get on with what they have been doing for the past couple of decades. But there's a big question as whether that will be successful without the U.S. as sort of the main driver of a global system that's geared toward low tariffs.
All right, Brendan, thank you very much for that update. Brendan Murray. And again, don't miss our interview. Secretary Bessent will be speaking with Bloomberg Surveillance at 7:30 a.m. New York time, 12:30 p.m. in London. Let's now turn to this corporate earnings season. Shares of CoreWeave getting hit following a double-digit after-market dip this morning, down by 9.25%. They had a disappointing earnings outlook as rapid AI data center expansion adds to margin pressure. Bloomberg Tech host Tom McKenzie joins us now. Tom, I thought these companies have to spend. What differentiates between the market punishing those spends and rewarding it?
Yeah, Danny, that's part of the challenge, isn't it? Because this is a company with a huge backlog as well in terms of orders that they have to spend to, of course, ensure that they can meet that backlog. $30 billion for CoreWeave. Of course, the spending comes at a cost, and there's an expectation story here as well, because this is a stock that's up 3 times since the IPO back in March. They actually beat in the second quarter, but the focus, it seems, for investors was on the losses, which came in at about 40% higher than the estimates. They've been spending heavily on acquisitions. They've been spending, of course, on building out capacity to meet that demand. And when you hear the CEO, Michael Entrata, talking about that demand, he says it's not letting up. And of course, we've had that reiterated in the recent earnings season from the big cap spenders in terms of the likes, of course, of Meta and Amazon and Microsoft, all continuing, Alphabet as well, to double down in terms of their capex spend, of which CoreWeave is going to be a beneficiary and remains a beneficiary. Key clients include OpenAI and Microsoft. But it seems the losses are there. They stood out, certainly for investors. Maybe a bit of profit taking as well, given the run-up that stock has had. Longer term, there is still that question as to how long this capex spend is going to continue. Most analysts seem to think this is still a 2026 story in terms of the momentum will still be there. Longer term, the question marks may be raised again for CoreWeave. But for now, it's the cost of having to build out to meet that demand that they're seeing. A silver lining, again, could be that pipeline, that backlog of orders of around $30 billion.
Elsewhere in tech, Tom, this one raised a lot of eyebrows. Perplexity making a $34.5 billion bid for Google's Chrome. Does Perplexity have $34.5 billion, Tom?
No, they do not, Danny. They do not have $34.5 billion. They're valued at about $18 billion. They have recently raised about $100 million, but they say that they would pile in other investment from other private sources as part of this bid. I think it's a reminder that Perplexity AI is a real contender in terms of at least nipping at the heels of Google search. And Google's most recent results, Alphabet's most recent results, suggest that they're still obviously generating huge amounts of revenue from that key part of the business. But Perplexity AI, which is the app, of course, with the AI search functions in it, is starting to carve out, at least around the edges, market share. It's gained a lot of custom and a lot of users. It's bold, it's ambitious. This could be a question that won't be resolved potentially for years, certainly months, because Alphabet has said that they are going to, of course, contend and push back against this legal finding from this US judge back last year, which found these and these monopolistic practices and anti-competitive practices. And part of the prescription could be the breakup of parts of the business, including the spinning off and the breakup of Chrome. Again, Alphabet has says it will push back on that in terms of its legal response. So that could take months and years to resolve. I think it's a reminder that the search part of Alphabet is still facing some of a challenge, something of a threat from some of these incumbents, and that Perplexity AI, with this additional $100 million that's raised, is very ambitious. They also made a bit of a play for TikTok as well. So they're a player to watch, certainly in terms of the search AI business.
Yeah, it's just been amazing to watch how something as mainstay as Google search really can get challenged by the changes happening in AI. Tom, fantastic reporting. Thank you for joining us, Tom McKenzie. Kava shares, those are also under pressure this morning. They are down almost 24%. It's the fast casual dining company. It slashed its annual sales outlook after a sharp deceleration last quarter. Let's get more from Bloomberg retail reporter Katie Linsell. Katie, what went wrong?
Yeah, so for Kava, this really shows that we've been seeing this fantastic story from this company really growing at a fantastic pace. But really, they're not seeing the same confidence from the US consumer that they've been used to so far. So US consumers are actually starting to get very worried about inflation, very worried about tariffs. And when we see that kind of environment, the first things that they start to pull back on are fashion and dining out. They're not looking at the sort of nice to haves, they're looking at the must haves. They're really cutting back their spending. And so for Kava, that means even though, you know, they are innovating as much as possible, they're bringing out different kind of dishes, they're still expanding their stores. We've seen that they've had to really cut their outlook for this year. year. They're looking, rather than the 8% sales growth, they're looking at 6% sales growth. And they've seen a really sharp deceleration in the second quarter. So, yeah, it really shows for Carver that things are starting to get real. It's not that same kind of growth story that we're used to there.
Well, to that point, Katie, and you were saying this of consumers pulling back. We were just looking there. It's not just Cava, it's Chipotle, it's Sweetgreen, which more recently also gave a disappointing outlook. When we evaluate them, something like a Chipotle, a lot of the conversation has been, do they need to change their strategy? How much of this is just about individual company strategy versus a consumer where fast casual doesn't give them the value that they want in a value-seeking environment?
So I think overall it is a difficult environment to be in. As I was saying, consumers are pulling back from dining out, which costs extra. You know, why not spend your money on your groceries and cook at home and dine much more cheaply that way? And that's something we're not just seeing in the US, but also in other geographies. Having said that, we've also got a difficult environment more broadly for food and grocery and snacking, with more and more consumers using these weight loss drugs, which means that shoppers are looking for sort of smaller portions, healthier portions. I do think that Carver broadly is hitting the right tone there. You know, their sort of combination bowls are known for proteins and salads and healthy foods. But really, this is proving to be a more tricky environment broadly for these kind of brands. So they've got to be very clever going forwards.
Katie, thank you very much for that. That is Katie Linzel. And by the way, in a sign of the times, both Wendy's and McDonald's are cutting back on their breakfast items, the maple bacon chicken croissant and the McGriddle, because apparently people are pulling back by not eating out and having fast food for breakfast. So sorry, go get your McGriddle while you still can. Okay, coming up, we're going to set you up for your trading day. There's Fed speak. There are high-level talks on deck over Russia, Ukraine, all of that coming up next. You're watching Bloomberg Brief with Danny Berger in New York. Let's get you set up for your trading day on this Wednesday. First up, don't miss our exclusive interview with Treasury Secretary Scott Bessent 90 minutes from now at 7:30 a.m. Eastern Time. We're also going to get some Fed speak that comes from Barkin, Goolsbee, and Bostic. Finally, President Zelenskiy and European leaders are gearing up for a call with President Trump ahead of Friday's U.S.-Russia summit. Some stocks on the move pre-market. CoreWeave had a larger than expected loss, spending a lot on AI and data centers, so margins looking poor. Shares down almost 10%. Cava also cutting its revenue forecast. Diners spending less on fast casual restaurants, down 24%. Finally, Circle down after a post-market offering of a combined 10 million shares along with its shareholders. Let's take a look at the bond market as we head to the end of the hour. It is a rally underway across the curve, but that's not what we got yesterday. Yesterday, it was the front end, which continues to move lower, but it was a long end yields that moved higher. In fact, the 230s curve moved to its steepest since January of 2022, whether that was driven by underlying components of CPI, maybe stickier services, or concerns about various government institutions like the BLS. Maybe a combination of them both, but we are seeing a 10-year yield up about 3 basis points, just under 4 at 4.25 on the dot. Your 30-year yield lower by 4 basis points at 4.8353. All right, that's it for Bloomberg Brief. Surveillance up ahead. This is Bloomberg.